Hello viewers, welcome to my channel. I'm Hasham Ali Khan. So far 11 problems I have completed on this technique of evaluating capital budgeting proposals. We have calculated the PBP, then ARR, NPV and PI. Now in the coming last three problems, that is 12, 13, 14. In these problems I am going to explain you the last method, that is IRR. Internal rate of return, and this method is little bit complicated, time consuming, but from examination point of view this IRR is very important. So these three videos are going to be very important, so watch all the videos from beginning till end, don't skip in between if you want the complete perfection on this topic of capital budgeting. Remember, all the videos are interlinked with one another. If you want perfect knowledge, watch all the videos, every video from beginning till end. So if you have not watched the earlier videos, I suggest you go to the playlist of my channel, select the subject financial decision making 2, select the videos of capital budgeting, be perfect about the concept, then you can come. Now, before starting the 12th problem, I expect my viewers to have a printout of the problems which I have given in the link under my description. Always keep the problems ready. Take the screenshot of all the points which I have written on the board, then I'll explain in detail. Now, see the problem number 12. A company is considering two mutually exclusive projects. The meaning of mutually exclusive, when one project is accepted, the other project will be rejected. So here two projects are given, X project and Y project. Any one of the project has to be selected. Both require an initial outlay of 2 lakh rupees. Cash outflow is 2 lakh for both the projects. And each have a life of 5 years. The company's required rate of return is 10%. That means we have to discount the future cash inflows at 10% required rate. The expected cash flows are as follows. Year 1, 2, 3, 4, 5. Project X, 80,000 for all the years. That means cash inflows are constant for Project X. Project Y, 1,20,000, 60,000, 40,000, 1 lakh, 1 lakh. So fluctuating for Project Y. Determine the NPV, net present value, and IRR, internal rate of return. First time we are going to solve the problem by IRR and of each project, and indicate which project should be selected and why. So finally, after making all the calculations, we have to give the suggestion which project should be selected, either X or Y, on what basis. That will be the conclusion. But before that, first we calculate the NPV, net present value. PV of cash inflow minus PV of cash outflow. See here, calculation of NPV. In one table itself, I am going to calculate the PV of cash inflow for both Project X and Project Y. Or else you can make separate calculations. If it is difficult to make one table with so many columns, you make two tables. One table for Project X, another table for Project Y. It depends on you. But right now, I am making all calculations in one table. First, year column. Second, PV factors. In the problem, it is given the required rate of return is 10%. So PV factors 10%. 0.909, 0.826. Already in the previous problems, I told you how to make the calculations of PV factors. Now, Project X, Project Y. Two broad columns. In this Project X, two subcolumns, and Project Y, two subcolumns. One subcolumn is cash inflow, which is given in the problem 80,000 for all the years. Second subcolumn is PV, present value of cash inflow. How we get the present value of cash inflow? Multiply the PV factors with cash inflows. 0.909 into 80,000, 72,720. 0.826 into 80,000, 66,080. Like this, you calculate all the PV of cash inflow, then take the total 3,03,200. This is the present value of cash inflow for Project X. Now same way for Project Y. Cash inflows are given in the problem 1,20,60,40, 1 lakh, 1 lakh. These cash inflows are given. Now multiply the cash inflow with PV factors. PV factors are given in the first column. So 0.909 into 1,20,000, you will get 109.80. Then 0.826 into 60,000, 49,560. Like this, you multiply the PV factors with cash inflow to get PV of cash inflow. Total of PV of cash inflow is 3,19,080. So in one table itself, I calculated the PV of cash inflow for project X and project Y. Now, we know the formula for NPV, net present value PV of cash inflow minus PV of cash outflow. So in this table, X, Y, two projects, PV of cash inflow, just now we have calculated 303,200, 319.80 minus PV of cash outflow. In the problem, it is given in the first line. The initial investment is 2 lakh. So 2 lakh. Subtract 3,03,200 minus 2 lakh, 103,200 positive. Here 319.80 minus 2 lakh, 119.80. So according to NPV criteria, which project is better? Y project. Because Y project is having more NPV. Higher the NPV, better is the project. So project Y is better according to NPV. Now I am coming to the main part, that is calculation of IRR, internal rate of return. Carefully you see, because first time I am going to explain the procedure of how to find out the IRR. Project X, separately you have to calculate. First project X. In project X, the annual cash inflows are constant, 80,000. Every year 80,000. So when annual cash inflows are constant, then these two steps have to be followed. First, step 1, calculate the PBP. In the previous videos, I have given the formula for calculating the PBP when annual cash inflows are constant. The formula is initial investment divided by constant annual cash inflow. So initial investment is 2 lakh rupees and constant annual cash inflow is 80,000. So 2 lakh by 80,000, 2.5. This 2.5 is the PBP. Now second step, step 2, very important. Locate two factors in PV of annuity table against year 5 such that one factor should be more than 2.5 and the other factor should be less than 2.5. So whenever the annual cash inflows are constant, then this step has to be followed. Not always, whenever cash inflows are constant. So two factors we have to locate in PV of annuity factor table against year 5, because life of the project is 5 years, against year 5 such that one factor should be more than PBP and the other factor should be less than PBP. More than 2.5, less than 2.5. That's it. Now I am coming to the PV factors. The PV table and annuity table. We need the annuity table, right? In annuity table, 5th year, in the line of 5th year, go on searching for 2.5. So 2.5 you can 5th year, 4.853, 4.713. Like this you go on up to 10%, then 11% to 20%, it is not there. Beyond 20%. Now 21%, 2.926, like this you go on searching, you will get here. At 28% it is 2.532. 28% it is 2.532. It is more than 2.5. Next value is 2.483. 2.483 is less than 2.5. So one value is more than 2.5, the other value is less than 2.5. At what percentage? At 28% and 29%. At 28%, 2.532. At 29%, 2.483. That's it. At 28%, 2.532, which is greater than 2.5. And at 29%, 2.483, which is less than 2.5. So we got two factors, 28% and 29%. Therefore, IRR lies between 28 and 29. In between this 28 and 29% lies our IRR, right? The actual IRR can be ascertained by using the following interpolation formula. So approximation, IRR is equal to RL plus DFRL minus PBP divided by DFRL minus DFRH into delta R. Now, carefully, I'll explain you all the meaning of these symbols. RL. RL stands for lower rate. We have two rates. 28% is the lower rate, 29% is the higher rate. So, RL stands for lower rate, 28%. DFRL, discount factor at lower rate. What is the discount factor at lower rate? 2.532. And PBP, payback period is 2.5. And DFRH, discount factor at higher rate is 29%, discount factor 2.483. And delta R, this delta R, difference between the two rates. The two rates are 29% and 28%. So 29 minus 28, 1. Now substitute all the values in the formula. IRR is equal to RL. RL is 28%. DFRL is 2.532 minus PBP 2.5. DFRL 2.532 minus DFRH 2.483 into delta 1. Now 2.532 minus 2.5, you get 0.032. And denominator, if you subtract, you'll get 0.049 into 1. So 28. You divide 0.032 divided by 0.049, you'll get 0.65. So 28.65 is the IRR, internal rate of return, for which project? Project X. So this is the procedure of calculating the IRR when the annual cash inflows are constant. Remember this point. When annual cash inflows are constant, these are the steps. Now I am coming to project Y. The project Y, the annual cash inflows are not constant. So the procedure will change. So the annual cash inflows are not constant. So we follow the following steps. Step 1, calculate the fake PBP. Here we have calculated actual PBP. But here we calculate the imaginary PBP, fake PBP. The formula for fake PBP, initial investment divided by average cash inflow. Here we have taken constant cash inflow. When we calculate actual PBP, it is constant cash inflow. When we calculate fake PBP, denominator will be average cash inflow. So we need the average cash inflow. So average cash inflow means total cash inflow divided by number of years. The cash inflows are given first year 1,20,000, second year 60, third year 40, then 1 lakh, 1 lakh. Total cash inflow 4,20,000. Number of years 5. 84,000 is the average cash inflow. Now fake PBP, initial investment 2 lakh divided by average cash inflow 84,000, 2.38. 2.38. Now step 2, locate one discount factor. Here in the previous case we have located two discount factors when the annual cash inflows are constant. But here we take only one discount factor. Locate one discount factor in PV of annuity table against year 5. A factor nearest to 2.38. So any factor, whether it may be more than 2.38 or less than 2.38, does not matter. It should be nearest. The factor should be nearest to 2.38. Now I am locating in the table, PV of annuity table. Against 5th year, you go on searching from beginning. From 1% you go on searching 5% line. In 5% row, you go on searching. Then up to 10% not there. Then 11 to 20% not there. Then 21 to 30%. It is 2.540, 2.494, like that. If you go on up to 30%, it is not there. Next 31%. At 31%, 2.39, then 2.345. Actually, we want 2.38. 2.38 we need. So here 2.345 at 32%. I think that 2.345 is nearest to 2.38. So at what percentage it is given? 32% it is given. At 32%, 2.345. So at 32%, 2.345. Therefore, we begin our calculations at 32%. But this is not final. We are just trying to find out the IRR. So we have taken a starting point, beginning calculation point at 32%. So first of all, we need 4 columns. Year column, cash inflows column, PV factors at 32% and PV of cash inflow. That's it. Simply you draw 2 more columns and leave it. Don't write anything, because we need another iteration. For that purpose, 2 more columns are required. Don't look these 2 more columns. First we concentrate up to 4 columns. 1, 2, 3, 4. Right? So PV factors are 32%. So you refer the PV of rupee 1. PV of rupee 1 table, 32%. In 32% you can see 0.758, 0.574, 0.435, 0.329, 0.250. Or else you can use the calculator. 32 means 0.32. 1 divided by 1.32. 1 divided by 1.32 is equal to 0.758. 0.758. Now second year, just press is equal to, you will get second year. Here is equal to third year, fourth year, fifth year. 5 times. Last 2, 4, 9. So 25. 0.25. That's it. In this way, easily we can find out PV factors. Now multiply 1,20,000 into 5.758. You get 90,960. 60,000 into 0.574. 34,440. Take the total, you are getting 2,700,000. 2,700,000 is the PV of cash inflow at 32%. Whereas PV of cash outflow is 2 lakh. According to the theory, IRR is that rate of discount at which present value of cash inflow will be equal to the present value of cash outflow. Suppose if you have got 2 lakh rupees here also, then no need of anything, any calculations. Directly we can say 32% is the IRR. If PV of cash inflow and PV of cash outflow both are equal, then whatever discount rate is there, that discount rate is the IRR. But here we cannot say 32% is IRR, because the PV of cash inflow is 2,700,000, whereas our PV of cash outflow is 2 lakh. Both are not same. Now we have to make one more iteration, one more calculation. So how to make another calculation? See here, concentrate now. To decrease the PV of cash inflow, we increase the rate. Actually, we need 2 lakh rupees, but we have 2,700,000 rupees. We have more cash inflow. So to reduce the PV of cash inflow, we have to increase the rate. Arbitrarily, we have to increase the rate. So here 32% we have taken. Because the difference is not much, only 700 rupees difference is there. So we increase the rate by 3%. So instead of 32, we add 3. 32 plus 3, 35. So we make another calculation at 35%. Let the new rate be 35%. We have to try at 35%. Now these two columns. Earlier these columns are blank. We have calculated up to 32% only. And we found that it is not equal. To decrease the PV of cash inflow, we have to increase the rate. Let the new rate be 35%. So this column I am making PV of 35%. And this is the PV of cash inflow. PV of cash inflow. Now multiply 35%. Again you refer the table PV of rupee 1 table. PV of rupee 1 table, 35% you can see 0.741, 0.549, 0.741, 0.549, then 0.406, 0.301, 0.223. Or else 35 means 0.35. 1 divided by 1.35. 1 divided by 1.35 is equal to 0.741. You can see here. 0.741. Now second year, simply press is equal to second year, third year, fourth year, fifth year. Every time when you press is equal to, you will get the factor. Right? 0.223. 0.223. That's it. So now multiply this PV factors with cash inflow. This PV factor with cash inflow. Cash inflow is 1,20,000. 1,20,000 into 0.741, 88,920. 60,000 into 0.549, 32,940. Take the total 1,90,500. Again, it is not equal to 2 lakh. Actually, IRR is that rate at which present value of cash inflow and present value of cash outflow both should be same. But it is not same. Earlier we got 2,700,000. Now we got 1,90,500. Actually, we want how much? 2 lakh. So this 2 lakh is between these two amounts, isn't it? In between these two amounts lies 2 lakh. That means our IRR lies between 32% and 35%. At 32% PV of cash inflow is 2,700,000. At 35% PV of cash inflow is 1,90,500. So PV of cash outflow is 2 lakh. So one value is more than 2 lakh, the other value is less than 2 lakh. Therefore, IRR lies between 32 and 35%. Actual IRR can be computed by using this formula. RL, IRR is equal to RL plus PVCI, present value of cash inflow at lower rate, minus PVCO, present value of cash outflow, divided by PVCIL, present value of cash inflow at lower rate. We have lower rate and higher rate. 32 is the lower rate, 35 is the higher rate. Minus PVCIH, present value of cash inflow at higher rate. Delta R, difference between the two rates. The two rates are 35 and 32. The difference between 35 and 32 is 3. So here I have written RL stands for lower rate, 32%, which is the lower rate here, 32%. And PVCI, present value of cash inflow at lower rate PV of cash inflow 2,700,000. PVCIH, present value of cash inflow at higher rate 1,90,500. PVCO, present value of cash outflow 2 lakh. Delta R, difference between the two rates, 35 minus 32, 3. That's it. Now simply you have to substitute the values in the formula to get IRR. So RL is 32 and PVCIL 2,700,000, PVCO 2 lakh, PVCIL 2,700,000 minus 1,90,500 into 3. 32 plus numerator, if you subtract, you will get 700. Denominator, when you subtract, 10,200 into 3. So 700 into 3, 2,100. So 2,100 divided by 10,200 is 0.21. So 32.21% is the IRR. That's all. So this is the problem in which we have calculated NPV as well as IRR. Now it is asking you to give the conclusion. I have not given the conclusion. Now you write, according to NPV, project Y is better. According to NPV criteria, project Y is better because the NPV is more for project Y. 1,19,080. This is more than this amount. So we suggest to go for project Y. Because mutually exclusive projects, any one of the project has to be selected. So we suggest the company to go for project Y. Now, according to IRR criteria, whichever project is having more IRR, that project is better. The first X project is having an IRR of 28.65%. That means the return from this project is 28.65%. Whereas project Y, the return is 32.21. So compare 28.65, 32.21, which is greater. 32.21 is greater. So conclusion, according to IRR criteria, we suggest the company to go for project Y because project Y is having a higher IRR. That's all. So I have completed only one problem, 12th problem. But in this 12th problem, I have explained you completely regarding NPV and IRR. Inshallah, in the next video, we'll start the next problem, problem number 13. So hope you got my explanation. Inshallah, you will get more confidence if you watch the video twice and thrice, and confidently you can write in examination. And if you're satisfied, give a like to the video, share my channel, give your comment, subscribe if you have not yet subscribed, and buy the super thanks which is given below my video. Inshallah, we'll continue the next problem in the next video.